The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome back to My Property TV, where you're watching Property Investing Matters, and it's great to see you back here for this week's episode and for another raft of great property investing learning. I'm Margaret Lomas. Tonight we'll be answering your questions on a whole range of topics with a focus on property and tax this week. You can be part of the show at any time by either emailing me at pim@mypropertytv.com.au, posting your question into a comment on my Facebook page, or by sending it to me via Messenger. Joining me tonight and ready to tackle your question is Ian Rodrigues from Bishop Collins. Ian started his professional career more than 25 years ago, and during this time he has completed an array of professional qualifications, including a commerce degree, the Chartered Accountants Program, and a Master's in Taxation. Tonight, Ian is talking about a range of things and looking at the proposed land tax reform in New South Wales. So it's a great chance for you to get all the detail you need about that reform. Let's welcome Ian to the show tonight. Ian.
Yeah.
Thanks for being here.
Great to be here.
I love having people in the studio. It doesn't happen very often anymore. I guess, COVID has turned us into a distance, kind of a nation. And so even people who used to make the trip to my office from Sydney, or to my studio from Sydney, even they are now doing it remotely. So I'm only getting once every 6 months someone in the studio.
Okay.
So
we'll dust off the studio.
I know, We basically had to get, a whole lot of things changed again, as you saw, because we're not used to it. But look, lots of things have been happening, and I'd like to start, I guess, with a general question rather than a property question. We talk about property all the time on the show, but it's really about all of the government-based assistance that we've seen, which last night watching the news has proven to be a really important part of why we're getting through all of this quite well. Yep. We've had Job Seeker, we've had increased JobKeeper, we've had loan repayment holidays, and a whole raft of other incentives and help for small businesses. How do you think it's going to impact for the future on people's businesses and on their lives?
Yeah, we're really seeing it at the coalface with all of our clients. In the accounting practice, we've got clients across all industries and all situations. If you own an airline or a cruise line, it's probably not a great time. Some of those businesses have been very highly impacted, whereas industries like clubs and hotels and restaurants have been able to manage through. And with the downturn in trade, they obviously had a period they were closed, but with the downturn in trade, but with government assistance, are doing quite well. And there's other businesses where it's been business sort of as usual, and they're doing quite well.
I kind of feel that where we're talking about areas that are purely really tourists who derive most of their product, their regional product, from the tourism market. I kind of feel like there was really only a small period of time at the beginning that there was a problem.
Yes.
And the reason I say that is because I've got an Airbnb up in Airlie Beach, and obviously lockdown cancelled everything out, and I had no one in there for 2 months. But the minute Queensland opened up again, I've been booked back to back.
Yes.
Since then.
Yep.
It's been a bumper year for that property.
Yep.
And I would assume that would also mean that for the businesses in Airlie Beach, that it's been a bumper year for them as well since then.
Yep,
but I think hospitality in just normal areas that aren't traditionally tourism, they're the ones that are suffering.
Yeah, I mean, every business and every region and situation can be quite different. But if you could group them up, there's sort of the people everyone in the lockdown where it was all uncertain and we were all, no one knew what was going to happen. Most people at first didn't even know what a lockdown meant. When you're listening, well, they're going to lock down everything but essential services. Like, what's that? And we've even seen just in the last week or two, South Australia, a lockdown where it was just shelter in house.
Yeah.
You know, they haven't had it for months, and you know,
didn't last long though.
no, one pizza guy. Like, I mean, the reaction. Everyone will have an opinion on the virus and the government's reaction to it. Like, it's such a dynamic thing, and it gets very confusing for people, right? And it's overwhelming for people, right? But people in business have still wanted to get on with it. That's certainly the case.
It feels like that, doesn't it? What about on people's lives personally? Have you personally seen, you know, people whose entire life have been impacted financially, or are people largely getting through?
Look, people are largely getting through. I mean, there's some people that have been affected, but again, there were people who were casual workers who did quite well out of JobKeeper, like in a short-term, week-to-week sense.
Yeah.
The uncertainty of their work is still a problem, right? And that was a problem before COVID. You've also got, really, the situation I see is the government's response around JobKeeper and JobSeeker assistance to businesses has been phenomenal, has been remarkable. The amount of money they've thrown at this. And what the economists are saying, you know, is correct about, well, there's been so much money pumped into the economy via the government. One, my kids are going to be paying it off. But secondly, it was designed to protect people's lives and livelihoods. And then we've all seen the people who've done well out of it, like retailers like Harvey Norman and others have had record sales.
Yeah, he stopped whinging lately, hasn't he?
Nice. You'd pay money just to have that. Yeah. But you know, whatever the whinge is about, but they've certainly been trading well. And that's just like a litmus test of retailers. So a lot of retailers are doing incredibly well. You've got the situation where a lot of that is people who have either got this extra money, stuck at home, want to spend, want to get out. There's also been the government in the last budget, the federal government, I think is spending something like $150 million to tell us, who gave them the $150 million, to holiday at home. I mean, that's good, but isn't it quite interesting?
Yeah.
Where else are we going, right?
Yeah.
But and the numbers are something like this. There was something in the order of $65 billion that we spend overseas, and about $45 billion that foreigners spend here in a normal-ish type of year. So there's this extra money that's going to be here to holiday at home.
I like to use, like, sometimes my individual experiences almost as a little bit of a measure of what's happening. And I saw a really interesting trend with my property in Early Beach that the minute the borders, not the borders opened, but the minute Queensland opened up, people started to come. But my average length stay was only about 3 nights. And I'm sort of booked up for about a third of the year next year already. But the average length stay is actually 7 nights next year. And it's almost like for a while there, when we came out of lockdown, we just needed to get away somewhere. And everyone just went and did these little short breaks somewhere. Just to get away.
Well, people can't go cruising, really. You know, there's a lot of challenges with that, getting back. No one's travelling overseas. People want to get away and do things. So you've certainly seen around like caravans and camping and retailing and Airbnb and holiday locations doing quite well. We're involved in self-storage a lot. Self-storage has shown up to be actually done quite well out of it. People need to store things when they're moving back home, or we can't quite get to the exact detail of why has it suddenly had an uptick, but it's very interesting to watch it all play out.
So what about property? I mean, you obviously are like all of us, that we haven't been through a pandemic before. We can't make any real assumptions on what's going to happen. But what do you think is going to happen? The government stimulus will stop around about March next year. Do you think there's going to be an impact on the property market?
There'll be some. There'll be some impact. I mean, it may be more that it's indirect on the fact that the surplus funds that are in the market for retailing might back off a bit. But the retailers are going to go from obscenely well to nice. They're not. It's not. I don't see it going off a cliff. Like suddenly the economy there's this depression that was pushed back. I think that the government has done what they set out to do, which was make sure that the economy and livelihood survive. Now the property market is a result of that. So the fundamentals of supply and demand are going to play out within the property market. And that's one of the points I wanted to make, was that you've seen an uptick in lifestyle assets. People who are suddenly thinking, well, where am I going to go and spend my time and all of that. So certainly a lot of these lifestyle assets have been in hot demand. So the tree changes, sea changes, all that sort of thing. A lot of businesses wanting industrial property has been quite strong. Like they're building warehouses, distribution, all that. The one that the jury's still out a bit on is offices.
Yeah, offices and commercial property, agreed.
And there's a project I was looking at, and again, it's been iced a bit because of the unknowns around demand for office premises, how that's going to play out in the future. I think one day we'll be looking back at it as a blip on the grander scheme of things. But yeah, when you're in the blip, it looks pretty daunting. Yeah.
I've got a really big office space here that I don't really use because we went digital quite a long time ago, before COVID even, and you know, we've got a lot of staff who work partly from home. And I've been thinking that the best thing to do with that is to turn it into serviced offices almost, because there's going to be a lot of people who will want to work from home but maybe want to retain a space, an office space that they can use. Interesting
thought, because the WeWorks, I mean, talk about hit by pandemic. I mean, this is where everyone comes in and shares everything, you know, like office space and all that. In the early days of the pandemic, I gather no one was going there.
Yeah, no one would go there.
So I think it's hard to say. I just think it's got a long way to run before that normalises. And in Sydney, all the offices are still, people are working from home, and a lot of places you can't come into the office unless you've got some legitimate reason. Now I think people have all had this dream of working from home being this fantastic thing, and it probably was for 5 minutes, and then now we all miss each other. And, you know,
you want to get back into the office.
Back in, yeah.
Get away from the kids and get back into the office. Yeah. Look, we've got a lot of questions tonight. I think we probably need to get to them.
Sure.
And so let's go to our first one, and it's from Dennis. And Dennis says, "Hi Ian, I will be retiring at the end of the year, but my wife will probably continue working casually. Our combined superannuation balance is 1.8 million, from which we plan to draw about $60,000 per annum. And obviously, however long that lasts on that 60,000 depends on the interest rates of the day, which should enable us to live comfortably as self-funded retirees. We have 3 investment properties, about 50% debt and 50% equity. Should we sell these and put the money into super or hold them?" I guess there's 2 questions here. If they do sell them, can they just dump the money into super? And secondly, should they be holding them instead for some diversification?
Yeah, look, Dennis needs to get some really thorough advice. These are big ticket items that you need to get good financial advice on. I mean, the first thing I'd say, you got 1.8 million in super. On any ordinary day, that would have been enough to generate your 60 grand, which is defined as a comfortable retirement. But depending on where it's invested at the moment, that could be a struggle. You know, that 60 grand is 3%, but that used to be an easy hurdle to hit, but not always anymore. The other thing Dennis needs to consider, because I think he was saying retiring at the end of the year, be mindful if you're planning to sell the investment properties, be mindful of capital gains tax. Because it applies at your marginal rate is going to be higher while you still have other income. And Dennis may be better off selling those when he has no other income or low other income. Might have a meaningful difference in his capital gain. The other thing about selling those properties is the debt. Now, we all know the rule. I think I've said it many times, like the time to get money from the bank is when you don't need it. When you do need it, they generally don't want to lend it to you. And at the retirement age, when you're getting away from earning an income, getting debt again can be very difficult. So maybe something where if you're happy with that debt level and happy with the asset, you might want to leave it as is. So capital gains tax, debt, and are the assets performing quite well? Your last point about can you actually get the money in a super? Well, that's a really good question too, because there are limits on what you can put in a super. And when it goes into this magic thing called super, which Dennis is going, it magically produces money, you need to understand where your super is.
Yeah.
What is it invested in and what is it doing?
Yeah. Look, Dennis, I'm no accountant, but I just did some quick calculations for you. And with regard to your property, then if you have 3 properties, and I'm calling them 300,000 value, probably a little bit more than that, and they're earning 5%, which they probably are. You've obviously had them for a little while. They're probably earning at least 5% on the price that you paid. You're probably getting about 15 grand a year in rent and only paying about 6 grand a year in interest. So to me, the difference is that positive cash flow that will actually add to the income that you're drawing out of super. And if you instead sold them and paid off the debt, say the debt's you said the debt was 50%, that 150,000 left over, whether you could get it into super or not, it's going to be hard for you to match that kind of return on it. would you agree with that, Ian? Like, it's going to be hard, especially at the moment, to match that kind of return on that money. So to me, at the moment, that money left in those debts and left in those properties is probably performing better than you can get somewhere else when you consider the after-tax value of those properties. You've still got deductions on those properties as well. Those deductions will help you to draw more out of super if it's available, but pay less tax because you'll write down a little bit of the money that you're pulling out as well. So it's a really efficient tax minimisation tool to keep the properties at the moment when you don't need the money, because you already feel that 60,000 is comfortable out of super, and it could be that the 60,000 is a relative 80 or 90 by keeping those properties, which is probably even more comfortable to you because of the tax advantages of holding those properties. And remember, the tax disadvantages of selling them, which Ian's pointed out, becomes that capital gains tax that further erodes what you've got left. Unrealised capital gain is worth a lot more to you than realised capital gain, and at this point your unrealised capital gain is in the property market earning money, probably gaining more, and also just earning that positive cash flow.
Yeah, there's some good points in that, because like the idea of tax deductions, Dennis may reach that point where the tax deductions become less relevant, and the people like when they're building these portfolios to go, I'm getting tax advantage. But when you retire and your fund's in pension mode and you're not paying any tax, you're not earning income, like this whole mindset needs to shift about the fact that I'm not paying any tax.
Yeah, but I'm thinking more that he can draw more out of super if it is up in that taxable rate, and then offset it through
possibly.
Those,
so that's why you need to get specific advice, because those circumstances may change year to year. But the other one that's a big one, and you know, Dennis and other people in his situation need to be comfortable about, is what level of debt am I happy to entertain in retirement? Most people think when I retire I'll just pay it all off. But that you're a long time retired.
It's not necessarily the
answer. And replacing debt.
Yeah. And if
the
the debt's
problem.
being comfortably taken care of by the property itself and you don't have to contribute to it, then to me, let it sit there and roll the dice on those properties.
A healthy level of debt is the thing that's important. And debt at the moment is the cheapest. We thought it was cheap pre-COVID in terms of 50-year lows and all that. It's gone even cheaper now.
Yeah.
So
you know, Dennis, my plan with my super, and this is certainly not advice for you because your situation is different than mine, is that my super will plug that gap between when I stop working and when I start needing to sell down the properties. So I'll use my super and get through that. And if it runs out, then I start selling my properties to fund my lifestyle then, not at the same time that I retire. That's
how much lifestyle are you planning?
Oh, lots. Don't you worry about that. I'm like, hey, it's not my lifestyle I seem to be funding at the moment. I still have kids, and despite the fact that they've left home, there's a lifestyle there as well that's being funded.
That's true.
Let's go to our next question. It's from Greg. And Greg says, hi, Margaret and Ian. I was just remembering Stephen Keane, I don't know why, where he had based some dismal property forecast based on excessive debt. Now we have some extra coronavirus-related government debt, and I'm curious what your opinion of Stephen Keane's, his opinion on government debt versus property prices would be now, and if they're likely to affect housing prices going forward. I'm thinking after a vaccine, when the economy is looking a bit better, there could be extra government-imposed taxes to reduce that debt, perhaps increase GST, income tax, state-based land tax, etc. It's a really good view to have. It's good. Yeah. I like to see our viewers thinking like this. I did read an article yesterday saying that, of course, our debt levels are much higher across the board at the moment. How long can we just keep being the nation that says she'll be right?
Yeah, I think, look, that's a great question from Greg. I mean, Steve Keane only makes, pandemic modelers look good. I have some sympathy for people trying to model and forecast. That is a tough gig because there's so many variables and they sort of seem to hate it when the world doesn't perform to their model.
Exactly.
It's very frustrating for them. But the point that they're making here is that, and it's one that I agree with, like whilst our response has been good from a public health point of view, from a government finance point of view, they've got it broadly right. Everyone will have an opinion about what they could have done a bit better, cut it off sooner. No one knew, right? They've got it broadly right, is my view. But when the day comes to pay this back, I don't think they've got too much where they can go here. Like he's talked about, will you increase income taxes? Well, that's got a whole range of issues with it. Yeah, increase GST.
Could do with going up. That I've always thought we need to be on a higher
Well,
GST.
we've had 20 years of GST now?
Yeah, I've always thought it should be 15.
Yeah, and that's been broadly right. And when we come to this chat about later in the show about the New South Wales property taxes, I mean, it's actually, I noticed early on Perrottet talking about reforming property taxes in the middle of a pandemic. We were all under our doonas hiding whatever we were doing, and he was talking about the need to reform taxes. Like, well, that's an interesting comment. And here we are a few months later. I think it's a brave move. I think it's a right move that they're trying to do. And I agree with you on GST. GST should be higher and income taxes should be a bit lower as a broad comment. That's been the case, but politically it's been dynamite.
Our political system doesn't allow for smart financial decisions to be made, unfortunately, because it's all.
We can only feel better if we look at America. So that's the way I see.
Greg, this is like one of those questions that it's really hard to answer, just like what will happen to property post-COVID. Very hard because we've never been through it before. We've never, or for a long time, since we've had this level of debt, what will happen is really anybody's guess. I'm a little bit worried about the level of debt, of course. Having said that, we do seem to come through these things okay, and something always seems to rock up. And if you had to roll the dice at the beginning of the pandemic and say which way to go, it seems like almost accidentally we chose the right way to go. I mean, we're all miffed about the lockdowns, and Melbourne was miffed about the lockdowns, but now everyone in Melbourne is overjoyed and saying, yay, we've eliminated it. It's almost like we've all banded together to work on this problem, and we've all agreed, with the exception of the idiots on the outside who have something to say about, it all being fake. We've all banded together to make all this happen, and I just kind of feel that it's going to be like that. I'm worried about the future generations, but the future generations are smart, and there's always been a solution that comes up that we can't foresee. That's how the wheel was invented, and inventions and ideas come upon as needs be. So I wish we had a better answer to your question, but unfortunately we don't. Well, if you've enjoyed watching the show so far, then you should consider becoming involved by asking us a question. We'll not only answer that question, but we will send you a book also for your efforts. Just email your question to us, and at the end of the show, each sender of those viewer questions we answer tonight will actually receive a bumper Christmas pack of 3 of my books. 3, not 1, not 2, but 3. To be in the running, you must have your questions answered on the show, and you can do that by emailing pim@mypropertytv.com.au, or just pop your question into any comment on my Facebook post. When we come back from this short break, we are going to be talking more about tax and answering more of your questions, so don't go away. We'll be right back soon. Welcome back. You're watching Property Investing Matters on My Property TV. I'm Margaret Lomas, and tonight I'm chatting with Ian Rodrigues from Bishop Collins about property tax, and we're also answering the questions that you have asked of us. Remember that all questions answered on the show tonight will receive the bumper Christmas pack of 3 books. So make sure that you email me or send me your question via Facebook, or you can send it to me via Messenger or my email address as well. Ian, interest rates are low at the moment, as you know, getting lower. Of course, you know, they dropped again this week just after I'd fixed mine, which is always the risk that you take. But, you know, fixing them is still a 1% differential between what I had before. So I'm good with that. I'm okay with that. But do you think now, with rates so low, is it better for you? Should you be buying or holding and waiting and seeing what's happening? Because I think people still worry that they're going to suddenly skyrocket again.
Yeah, there's two aspects to whether you should be buying, holding or selling. Like, what are you buying and all that? But the financing of it, I think, like, if you look at the forward projections on interest rates and the fixed rates, they're very low. So into that 5 years, it's still quite low.
The implied yield curve.
Yeah, it's a little bit up.
When I looked at it yesterday, it's flat.
Yeah.
In the foreseeable future, it's flat. I've never seen it like that before.
Yeah.
I've always seen it flat with a little peak at the end.
Little curve at the end.
Nothing.
Not even that. Yeah.
It's like flat now.
Oh, I'd have to have another look. I saw that same thing, that little curve on the end.
Yeah.
You know, the banks know, with their experts far better than us, where it's going to be. So I always view fixed rates as not trying to beat the bank, but just I'm locking away my commitment.
Yeah.
That's it. It's just insurance.
Yeah.
That's the way I see it.
And I think that's an important discussion to have around fixed rates. You know, when fixed rates were a lot higher than they are now, to me, it's like not worth that gamble of locking in at a really, really high rate.
Yep.
You know, I've seen people who locked in at 5% last year or 2 years ago for 5 years, and they're still sitting at 5%, which is double what they could be doing now. I think when you're talking in the twos, which is pretty low, I think the risk behind locking in becomes
Very
a lot lower.
Yeah.
You know, in my case, I locked in for that 2 year period, knowing that in order for that to be worse than the variable reaches, if the variable keeps going down, then official interest rates had to be at around about minus 0.75.
Yeah.
So I figured that then created, on balance, a risk worth taking. And even if they got to that, then while I'm waiting for that to happen, I'm actually ahead of the game.
Yeah, that's right. Yeah,
So,
and that's exactly the way to look at it. I mean, it's the known commitment rather than the variable commitment. There's a lot of reasons for it. So the bank's always found similar levels of percentages of borrowers fixing. It hasn't really sort of changed. I think a lot of people look at it and decide to leave it, in my experience, and but it's very personal as to what suits you. And if you've got a high level of debt, I mean, the reason where I'd say to take it, where it's a no-brainer, is where you've got a high level of debt, where if rates were up 1% or 2%, you actually
wipe
have
you out.
you have a cash flow problem. Now, no one should really be borrowing at those levels. You know, lending money from the bank is always, got an element of risk to it. Not saying you shouldn't do it. I'm saying you actually should do it. That a healthy use of debt is very important, but you need to be aware of, what that healthy level of debt is and the conditions that come with it.
So in relation to, should you buy or hold, I guess the answer to that question that I always give the viewers is that it depends what you're talking about as well, because there are areas, I've been looking at a lot of the last quarter's figures and seeing that while there's many areas that have actually increased in the last quarters, there's many that haven't as well. And it's just proof again that it's never about should I buy, it's about where should I buy.
Correct.
There's always there's always a place to buy.
So we had in order to get a bit of a snapshot, we are lucky we get that at the coalface with our clients and general discussions. We had a look at our super funds, which are, again, our super funds are no different to the 600,000. People are sitting on a lot of cash. There are a lot of people sitting on a lot of cash, and I describe it as fence sitting. They're really sitting there going, I'll just wait and see.
And there's no money in cash at the moment at all, no money.
Well, it's never an investment as far as I'm concerned. It's a holding pattern.
I mean, to me, it's a no-brainer, because you think about this. You put your money, if you do have a lump sum of cash and you've got it in the bank earning, 10 basis points of interest. So
maybe 20 if you're lucky.
On 200,000, you're getting $2,000 a year on it, if you're lucky. Instead, buying a property in just a normal everyday suburb where there's always families, that's always going to be rented at some rate. If not market rent, if rents go down a bit, you can drop it a little bit. But that's a 4 or 5% return on your money. That's a much bigger outcome. A 5% return on 200,000 is $10,000 a year, not 2.
Well, even if it's less, it still is, right? But I think the fundamental point I like to make is that cash is not an investment. Like sometimes people call it in the investment classes, cash, property, shares. I say it's cash, property, shares and your small business are different. And the risk and the return is appropriate through all of those. But cash is really only a holding pattern. I mean, there were a couple of years there during that GFC, which we've all forgotten about because we've had pandemics to deal with, but where cash was really good. And that was about the only 2 years, in a long, long time where cash rates were quite high. So now I think people are sitting there just waiting to see a little bit. And the risk with waiting to see a little bit is the opportunity, has been missed for a period of time, and the opportunity to wait for a bargain doesn't come. Or to buy something that's a good investment, will always be there somewhere, like you say. But I think people are just sitting back a little bit just to see, and that's human nature.
To me, people worry about the fact that they'll buy a property that will lose a bit of value and they'll see their savings eroded a little bit. But what does tend to happen in my experience is even properties that lose a bit of value, providing you've used the 20 questions and bought in the right place. So I really want to get that clear.
Yeah.
You have to do the research and buy somewhere that isn't at risk of falling in value. So those with the greatest risk of growing, I guess, can also have the greatest risk of falling, potentially. But even if the capital value gets eroded a little bit in the short term, usually the rent doesn't, and you're still getting that yearly return in the form of your rent on it.
Yeah.
And it makes a lot of sense.
Yeah.
Let's go now to land tax.
Sure.
Now, New South Wales is talking about introducing a land tax, and it's a little bit Greek to me at the moment because they're saying it's your choice, and I don't understand how that's going to work. Can you sort of give me like 101 in 1 minute?
How long have I got?
Yeah, about a minute.
Okay. Oh well, what the government's put up now, is something that's been needed. I think they've put out. I've got the New South Wales budget, announcement. I've got the consultation paper, all available on Treasury's website if you feel so inclined. It's worth the read. It's not a very difficult document to read, but the states rely upon government grants, property taxes and payroll tax. Fines are 4%, those littler stuff. But they're three big taxes. So government grants, GST funding, payroll tax and property taxes, which is stamp duty and land tax. New South Wales has had that since 1865. It really hasn't changed much. Land taxes and stamp duties have been there for that long. They've tweaked it and all that. So now they're talking about a fundamental change. There's some subtle things they've mentioned in these papers that I'm intrigued by. And they're talking about things like, the first one was you can choose, if you're in the system now, no change.
Okay, so if you've already paid your stamp duty for your property, then you won't have an extra land tax on top of that. Unless, of course, you're an investor because you have land tax anyway.
You'll still be paying land tax. You've already paid stamp duty, no change. You sit there grandfathered.
Good, yep.
So that's good.
Yep.
But when you come to buy one, they'll give you the chance of upfront or afterpay. That's what I should do.
Afterpay, okay, cool.
Pay it off over years, right? And they're saying that is sort of removes a big barrier to paying up front for a lot of people. Now, for investors and all that, I don't know that that's such an issue. Usually you factor that into your whole thing. So, look, it's interesting that they're putting it up. I think it's economically a good idea, but how you get there has got, you've got to take people on that journey and to get them there. But some of the interesting things I saw that intrigued me were the fact that they were talking about you'll have a choice, so you can go under the old system or the new system. Now, once the property's in that ongoing property tax is going to attach to that property. So let's say I buy a property, I go, I'll pay it off. I'll pay the property tax every year instead of up front. And Margaret comes to buy it off me. You're going to buy a property that has...
So I don't get the choice?
Well, you're going to buy a property that has that attached to it.
Yeah.
Now, does that mean you get to pay it up front and convert it back, or how do you go now?
We don't know how that's...
Yeah, so I'm imagining two apartments in the same block identical, one paid up front, one's got ongoing. They're the same price. There's a lot of...
Be interesting to see how they manage
how that plays out. Yeah, so a lot of questions to come. We've only got 40 pages of reading here to go with. So it's at consultation stage. The other one was balance rates, and they're saying residential owner-occupied primary producers are going to pay lower rates than investment properties.
Of course.
Yeah. and who would pay lower rates than commercial properties.
Right.
So it appears they're talking about a
tiered system.
A tiered system. Not to mention what they've left out of that is all the exemptions that they currently give people. Churches, one of the largest landowners in the country, don't really pay a lot of property tax. Clubs, not-for-profits, they said prime producers, but a lot of farms. So all that's yet to come out. I mean, I don't think you can address the system by just saying, oh, we're introducing afterpay.
Yeah,
there's a lot more to it than just that.
There's definitely a lot to consider as well. And I guess how long you expect to hold the property for will play into your decision as well, because, you know, if you think, well, I'm a flipper or a transitioner and I'm going to live here and here and here, then you'd probably just want to go on the land tax system, because that's going to be less for you each time.
Well, you're going to pass it on to someone buying it, so presumably...
I don't care about the person buying it.
But presumably they would look at the two identical units and say one comes with an ongoing obligation.
Yes.
Like presumably.
Yes.
Like, you know, that's assuming consumers are rational economic animals, and they, you know, they're not always...
Never seen that before. Okay, all right. Well, that's very interesting. But I guess we just have to wait and see how... It's going to be a hard one for them to put in place, I think.
The interesting thing is I think it's long overdue. Like, we really haven't had major changes. The economists will say we should do it. They need to get it right. And my point too is if New South Wales does it, remember, all these property taxes are state-based.
Yeah, so do you think other states will follow?
Well, ACT, remember we've chatted on the show earlier about ACT did some of this. Now, you know, there's relatively 3 properties in the country in the ACT. I mean, it's a very small market compared to the rest of the country. New South Wales is not a small market. No. New South Wales is the biggest market.
40%, I think.
So if they do it, I think there's going to be, you know, it'll have a flow-on effect.
Yeah, it'll be a watch and act situation, won't it? They'll see how we go with it, and then they'll
see if it's political suicide and decide.
All right, let's go to more questions. Next one comes from Kane, and Kane says, "Hi, Margaret and Ian. I'm having a lot of trouble getting a bank to give us an interest-only loan at the moment. I know you say not to take P&I on your investments if you have debt on your own home, which we do have. This is making it really hard to invest. What do you suggest?" I think this situation is starting to ease a little now, and I think those interest-only loans are coming back. And I noticed today that St George Bank introduced a cut to their interest-only loan fixed rates as well.
Yes, okay. Yeah, there was a point in time not that long ago where interest-only and variable interest rate loans had the same rate, and then they gave it as a fair old about 1% gap, and then, you know, it became in people's interest to take a P&I loan, even though that advice, all things being equal, I'd agree with that. You know, pay interest only on your investment stuff and pay off your home loan. But there became more factors, and that gap has now dwindled down to, I think, very small.
Absolutely.
And really, the way finance has become and getting it from your bank, it really is, you just have to cut the best deal you can.
Yeah, and you can cut deals as well. You know, Kane, you've probably heard me mention on the show quite a number of times that some time back I decided to change my interest-only loans to P&I loans. And I did that because of that gap. I found that for the amount of money I was paying just to the interest on my interest-only loans, and I do have a lot of them, that I only had to pay a very small amount more every year in P&I repayments, but a significant proportion of that payment actually became a principal repayment because the rate was so much lower. I think, you know, for the interest-only loans it was 4.5%, and I was at early 3s on the P&I, and that 1.5% difference really just translated into equity in the loans and repayment, and I began to pay those loans off really quickly. And I really like looking at my internet banking now because I actually go through this really weird anal process every month of writing down all my loan balances again and working out how much I paid off in that month or how much I'm going to pay off by the end of the year. I do all these calculations. I go right so many months to the end of the year and work out how much I'm going to be paying off, and it's great. It feels really, really good.
I don't look.
I know. That's weird. That's weird. But now I think the differential's a little bit less. My advice to you is, first of all, you need a good broker. You know, we can definitely help you if you need that, to get the best rates for you and to get that interest-only loan if you really need it. But don't worry too much if you can't get it, because it could be that the differential's not that great because of this difference between interest-only loans and their interest rates and P&I loans. It might be not such a big deal. in the olden days when they were equal, you definitely wanted interest only until you'd paid off your own home. But these days, if the differential is big enough, then it doesn't make that much difference. And the principle behind that advice years ago has now changed a little bit because of the way interest rates are. Next question from Michael. And Michael says, "Hi Margaret, thanks for answering my question. I was wondering if you could offer any feedback on Rockhampton for light commercial industrial. With all the mining activity in the residential market improving, does this flow onto commercial property there?" I had a look at Rockhampton this morning, Ian, and did notice that in the last quarter, Rockhampton has been one of the better performing residential markets.
Yep.
Agriculture, exposure to the mining up around Gladstone there. Yep. Does it typically then flow into commercial, like light commercials, obviously, shops and...
Yeah, I think it does. I mean, the real question mark is which flows first, which one leads the other, but it's activity and demand. So there's obviously, if there's things going on in Rockhampton, business ticking along well, all markets will sort of improve, like the retail, the residential, the commercial, all those sort of things. So, all boats lifted by the tide is my view.
Yeah.
As to which ones are lifting first or last, it can have some short-term timings. Like if people have got to come there, are they coming there because businesses have already moved there, or are they coming there and businesses are then moving up there? And so in the short term, you may be able to jump into the right market at the right time. But I think all boats will be lifted by the tide.
Yeah, Michael, I guess if you've got to really understand the entire economic puzzle and what's really going on. And the reason that property grows in value is because demand increases, and the demand will probably, in an area like Rockhampton, increase for one of two reasons. Firstly, because people are moving to the area and the population is growing. But secondly, because the people in the area are making more money and spending more money and therefore upgrading their homes and wanting to buy. So more people are starting to be able to buy, more people are entering those markets, and therefore we get that pressure on prices. And if they're making more money, it's because, generally speaking, the commercial markets and the economy is doing better. So, mining's doing better and agriculture's doing better and all of those things are doing better. So they're employing more people, and when they're employing more people, there's not as many people to take up the job, so the wages have to go up, and it's a big cycle. So the fact that the property market is showing an increase in value indicates to me that there's a small recovery coming to Rockhampton, which should translate into better economy all around for that area. A different question you need to ask is it better for me to buy light commercial in Rockhampton than, say, residential or commercial in somewhere else? So that's a different question altogether. And in terms of that question, I wonder if you're asking me that because you live up and around that area and you're thinking of Rocky as a great place to invest, or whether because you've heard that it could be a place to buy. In which case I would say at this point in time, there are other markets that I would be more likely to buy into, both for residential and commercial, than Rockhampton.
I think it's an interesting question too, in that people are looking at commercial properties as well.
Yeah.
Yeah, they're a different beast.
And you have to be very careful as well, Kane, about what kind of commercial. Obviously, offices are going to be impacted for some time yet. You need to be careful what you're buying, even shops, with people shopping more online. Next question from Marie, and Marie says, "Hi Margaret, is an interest-only loan for an investment property worth the risk, considering rates are likely to remain low for quite some time yet? We are savers hurting through no fault of our own." I'm not sure I entirely understand what Marie's asking on this one.
Yeah.
But if we're just talking about pure risk, what increased risks are there with an interest-only loan over a P&I loan?
I don't really see risks that aren't otherwise created by yourself. The risk is you. So if you take an interest-only loan and you don't direct the other payments that you may have made, and you've spent it on handbags and shoes or something, right? Run up the credit card or whatever. That's the risk I see. That the excess money isn't being taken off the debt or kept away or reinvested.
And that risk is amplified if the property that you buy is one that you bought without a lot of due diligence and therefore doesn't grow.
Yes.
So I think the big risk in an interest-only loan is that you buy a property with an interest-only loan, the property doesn't grow because you didn't research it well, or something happened there that was outside of your control or understanding, and therefore you get to the end and the property hasn't grown and the debt hasn't been paid off. And it's been a nil-sum game for you, and you've probably had heartache and headache along the way. Let's be honest. Owning investment property carries difficulties,
Yes.
you can't. By no means is it an easy investment.
Yeah.
So you'll have bad tenants, you'll have all sorts of things go on. You say that you're savers through no fault of your own, or you're hurting through no fault of your own, but you're savers, which indicates to me that if you had an interest-only loan, that you would be directing that money to something else. The only reason that you have an interest-only loan on an investment property is if A, you have your own personal debt that's not extinguished yet, and therefore those excess amounts of money that would otherwise go to a P&I repayment go into your own home. Or if you're the kind of person who will take that money and invest it elsewhere. When I say elsewhere, I mean into something other than property, so potentially the share market or a managed fund or some other, or even a property trust, some other investment, not put in the bank.
Yes.
Because it's better being paid off your loan than it is being put in the bank, or at least put into offset. And you say your savers hurting through no fault of your own, but if your savings is sitting in offset against any of your loans, then you're getting significantly more, particularly when you consider after-tax consequences of what you're saving. You're getting considerably more than you can get with your money in the bank.
That's right. Yeah, it's a tough one for savers, because the people who have gotten by with sort of putting money aside and earning money in cash management or term deposits, it's just incredibly hard. It's just not doing anything. So,
you know what? If people have got money in the bank at the moment, and they aren't offsetting it against debt somewhere, if they've got it, and if they haven't got debt somewhere, maybe they should get debt somewhere if they've got money in the bank, safely. But if you've got a big chunk of money sitting in the bank, maybe look at leveraging that into another investment through some kind of manageable and relatively safe debt. Or the worst case scenario, if you just really don't want to do that, then put it in offset against one of your kids' loans.
Yeah, well...
You know what I mean?
Yeah. It's an interesting one, because the question Murray's asked really triggers to me about people's mindset to money. And I've been asked for some time and finally agreed to do a presentation on money mindset. Because having dealt with people for 30 years, you can talk to people for 5 minutes and quickly sort of understand how they think about money and how they act. And I'd have to say, not all of it's rational. Not all of it's great. And if you're trying to tell someone who's got a particularly money mindset that that's a good idea, you're not going to get very far. So
when I worked in the bank as a very young teller, I remember we had a customer there who had $200,000 in a non-bearing interest account.
Oh, right, yeah.
Because he didn't want to harm
the banks
his
love them?
pension. Yeah, well, we used to love them. He had a little passbook.
Yeah.
Because he didn't want to harm his pension. Now, the interesting thing at the time, and even now, is that he was only losing 50 cents in every dollar of his pension for every dollar in interest he made.
Yeah.
So he was still going to be ahead by earning interest, yet you couldn't convince him
money.
that he needed the money put in an interest-bearing account.
I know.
Back then, you could probably get 5% on your interest-bearing account. So.
It is hard, because business people who are savvy with money, you don't have to provide a whole bunch of background education to sort of go, well, this is what we need to do. But for a lot of people, they need to get their mindset to money. And that's why they comment about, there are some people that are by default really good savers. And there are some people that are terrible savers. And they'll admit it to you.
I got a couple of terrible savers in my family.
Who shall remain nameless.
Got a couple of good savers in the family. Got a couple of terrible ones as well. I think that's
They're more fun to hang out with, though.
Oh, yeah, you think? I don't know. Well, it is time for us to take a quick break so that we can get ready to answer more of your questions. There's a few more to come yet. While we've gone for these few short messages, why not email your question to pim@mypropertytv.com.au so that you can also be in the running for that great book prize, which of course this week are those 3 books. You might see them up on your screen in a moment so you know which 3 exactly that you're getting. There they are. 3 of my best books up for grabs this week. Well, we'll be right back soon with more of the show. So glad to see that you stayed tuned in for Property Investing Matters. It's been my pleasure for 2 years now on Web TV and 10 years prior to that on Sky News to bring you a weekly dose of property investing education, free of charge and with no catches, and certainly a couple of glitches every now and then. It's just when I can't remember what I'm supposed to say to you. Tonight, Ian Rodrigues from Bishop Collins is helping me with that quest, so it's great to have him in the studio. You can join in with a question of your own and you will be in the running to score that fabulous book prize just by emailing your question to pim@mypropertytv.com.au or head over to our Facebook page. Ian, we've had some great discussions around this whole land tax thing, and it's interesting, you've just been saying in the break that even the Labor Party seems like they're going to support some changes to the New South Wales tax system.
Yeah, we've had 10 years of politics where if one side says, black, the other side says white, where the politics of no and not agreeing. And it's interesting the Labor Party have initially said, we think it's got merit and we're happy to look at it. So when you have both sides of politics agreeing to a tax change, it's like, well, hang on, what's going on? So now one of the things I noticed in there, 40 pages of stuff, is that the intention of this is to be revenue neutral. So this is meant to be economy stimulating and job creating without affecting the government's coffers over time. Call me a cynic, but I can't imagine them legislating that they're going to do that. I think ultimately they will reap more out of it than they think, But look, it's got merit. I don't want that to be a
I think if you play it out to its natural conclusion as well, it's going to depend upon how people choose to actually pay that land tax. And, the generation that's coming in behind us, the younger generation, I think are going to be people who turn over property a lot more quickly. I mean, our parents and us were people who got a place and sort of stayed in it. But I tend to see, there's that 25 to 35-year-old age group really that tends to get bored with things fairly quickly. So this could give them the opportunity to turn over really quickly just by paying that.
Well, I think it's
broad-based land tax.
Everyone would agree, like the economists, everyone agree that people turning over properties without the barrier of stamp duty is a good thing. So if you need to move to Rockhampton to work, well, you should just buy a house there. At the moment, you'd think, I've got to sell here, I've got to buy there. There's all these big costs. Now, if they get rid of it and it's an annual cost, it all makes sense, right? But time will tell how it plays out. I think I'm very supportive of it, but I'm always mindful of the, the revenue neutral claim because no one can guarantee that. I mean, it'll be very easy for future governments to adjust the property tax. So the new property tax will be much like rates. And we get them every year and people go, oh, gee, look at them, they just change the percentage and away you go, you're up for more.
Next thing to get rid of would be real estate agents. Some of them are probably watching the show as well, but it'd be good to have that middleman gone, wouldn't it? Imagine just like an online portal where it's a bit like a share market where it's a property market and the properties are all on there and they just change hands, T+3 and a small brokerage. And then how great would that be? Yeah,
well, it's an interesting thing because most markets now, look, if you think about some of the biggest companies in the world, like Amazon, don't own any goods.
Yes.
That sort of online marketing, real estate has sort of gone maybe 10% down that path.
Yeah.
But it makes sense that it will.
Yeah, it'd be great. Really good. Okay, let's go to our last couple of questions for this evening. Next one comes from Jake. And Jake says, hi, Margaret and Ian. In regard to land tax thresholds for companies and trusts, does the threshold apply to each trust or company or the total spread across a few trusts or companies you may own? Currently, I have a family trust and a company, so does that mean I'd have the equivalent of two thresholds added together? It's interesting because this land tax thresholds and land tax changes from state to state as well.
Yep.
I know we're talking about land tax a lot tonight, but it depends on what state you're in, doesn't it?
Totally. So land tax, every state that has land taxes has a threshold and they have a rate. The simplest way to explain it in terms of this idea of like I own a property in my own name and a company and a trust and a super fund, trusts generally don't get a land tax threshold. That's in New South Wales. As we saw
but
in
I think they do in Queensland.
Yes. So
350,000 in
something
Queensland.
like that. So you need to look at each situation. Self-managed super funds are a trust, but they get a land tax threshold. So it's like this completely reverse thing. There are numerous exemptions for use. So if you are a primary producer, all those things come into it. And then the main thing that was it Jake asking is about grouping. So there are significant grouping provisions that are trying to stop you from just putting it in different entities.
And they've just introduced that in South Australia where it's an aggregate across everything that you own, so that you can't get that threshold off. They used to have it so that they had a threshold available or a tax-free threshold available for a trust, one for a company and one for individuals, and they found that that's what people were doing. They just kept buying in a different entity to avoid that land tax, but now they aggregate it across all of them, so that's no longer an advantage. And I think that isn't introduced into Queensland yet, but I think if it works out really well in South Australia.
And I think Jake was asking from Queensland, was he? So New South Wales has had grouping provisions for a long time, so if you can understand them, you're doing well. But the intent of them is to exactly do that, stop people just putting in different entities. And of course, if you're looking at putting things in an entity just about land tax, you've missed the other parts of that equation. You need to be thinking about income tax, capital gains tax, not just land tax.
Yeah, you don't put it in another entity to save that land or to get
and
that
forget
land
about
tax
the other
threshold.
issues.
Because, for example, to me, especially in the early part of your strategy, putting something in a family trust quarantines you from some really valuable deductions.
Losses,
that you can use, especially if you're in those higher income tax brackets.
Absolutely.
Because those losses get quarantined in the trust and you don't get to use them personally. So often what you're losing every year out of not being able to use those losses by not taking it in your own name would be way more than any land tax that you're going to save.
Land tax is one that I find that as a tax, I've always thought it's a fairly good tax, but they haven't got it 100% right. Taxing land economically makes sense, and people hate it. Like you get this big lumpy thing. Like if you had to pay your income tax once a year, you'd hate that too. But when they take it out of your pay, you don't notice.
Look, Philip, a better way for you to avoid that tax. And at the moment, I think you're in Queensland and I'm pretty sure that you'll find that you do get that one threshold for each. But if that changes, it's usually retrospective as well, because that's what happened in South Australia. We used to be taxed according to the entity that the property was held in, and then all of a sudden they changed it and it's grandfathered. If you own property at the time, you're now under the new system. So that could happen to you in Queensland. But more importantly, if you really want to be able to save land tax, then buy widely in every state and get a tax-free threshold in each state, because that doesn't group. They don't group across states. And that's the way I've managed to keep my land tax bills really, really low, because I own property widely all over Australia.
What if the states actually got together and realised that the property taxes should be uniform across...
One threshold across Australia.
They can't agree on much now, so...
it's not going to happen.
So we're pretty safe.
They don't even open the borders to us in Queensland. How are they going to ever...
Is it part of Australia still?
I just can't imagine Glad and Anna getting in a room together and actually being nice to each other.
I think my next trip to Queensland, I'll turn up with my passport. It's like, do I need this?
Oh no, that's WA. They definitely want to succeed for the nation. Well, apparently they actually did a little mini survey on would you succeed from the nation and become our own country, and 28% of respondents said yes.
Oh, that's nice to know, isn't it?
There you go.
I don't think they've done the maths. I'm not sure they know how their world works.
Well, it works really well when mining's good, but it doesn't work so well
but I think
when it's not.
this is a point that I haven't really heard too many people making, but this is the thing, like whilst everyone's been happy generally, the politicians have been popular locking down state borders, I mean, if there wasn't JobKeeper and the federal government funding those states, within 5 seconds,
they'd be gone.
They're going to want those borders open again, because business would just come crashing down. So the federal government's sort of paying the bill, the state government's yielding the political reward for keeping people safe. And JobKeeper is scheduled to end, I think, early next year or middle next year sometime. So we need to get back to being Australia, I think.
Absolutely. Don't get me wrong, I love WA as well. Everyone knows that. Technically, I'm part WAan and part Sandgroper.
You've got a Western Australian
and 3
passport.
of my kids are all born there, and my husband. So in our household, we're basically 70% Sandgroper in our household anyway. So I'm allowed to poke fun at the Sandgropers because I'm sort of one.
Yeah.
Let's go to our next question. This one comes from Leanne. And Leanne says, hello, where is the best place for a couple in their early 50s to start building up a portfolio? At information gathering stage, but I'm finding there's so much information in the marketplace for this. And so much of that is dodgy, can I say?
Yeah.
So much of that is actually dodgy as well, isn't it?
Yeah, it makes me sort of, you read the question and you sort of think, look, you really need to do something here, but I mean, you've been, like the information, the education that's got to go with it, it takes years to develop.
Yeah.
I say 50s, it's never too late. Ideally started sooner, but if you can start, get the education, make a decision. There's always somewhere good to invest. I think with information too, I always find that the best thing to say is, well, who is that information coming from? If it's from an expert, independent source that isn't trying to sell you something, then that's probably good information to rely upon. If it's from an agent or builder or developer or someone who's saying, you know, buy here because this is a wonderful property, I mean, it's ultimately biased. So,
Now, Ian, did I just hear you say that she should be ringing Destiny about the Destiny property match?
I didn't want to plug it. I didn't want to plug it that directly, but an independent expert bit of advice that isn't trying to sell you anything other than education, information.
Absolutely.
Is what you're
Absolutely.
after.
And lucky for you, Leanne, because your question has been answered tonight on the show, you get all 3 of my best books. And that's a really, really good place for you to start, because it'll help you to understand how to disseminate information. It'll educate you and give you the confidence to at least go out and look for someone to put on your team to help you buy your next or first investment property. And at 50, it's not too late. I would have liked you to have started a little bit earlier than that, but you've still got a good, solid 15 years or so to really get together a nice portfolio. And please give us a call if we can help you with that at all. We have one final question tonight. This one's from Philip. And Philip says, hi, Margaret. Before I read your books, I made the biggest mistake. I bought a service apartment in Port Douglas while on holiday. Obviously, this was a disaster for reasons you warn about in your book. Ian, I think there's actually a part of the book that talks about buying a Port Douglas serviced apartment while you're on holiday. So I have now sold the investment property, but due to the way I financed it, I was left with part of my mortgage unpaid, sold the IP for less than what I paid for it. Is the ongoing interest I pay on this borrowing, which is directly related to this now sold property, still deductible, given that I no longer receive rental income from that particular property? I'm sorry you did that, Philip. The moral of that story is, for all the other viewers, is to do some reading, get some education before you go out and buy. It's hard because, honestly, those dodgy spruikers who sell you these properties, they'll tell you anything that they need to tell you to move property, and it all sounds great and legitimate when you're hearing it. Yeah,
I've been... years ago, I remember dragged out of, you know, one of the dream worlds or something like that. You're just happily enjoying.
Where did you go?
enjoying. No, they tried. They were never going to get me there, but gee, they were like.
They're good.
Yeah, they're like a bull terrier. They're not going to let you go. Like, you can start off politely saying, I'm not really interested, but you really had to get to the point of being a little impolite, which you don't want to be, but that's their modus operandi, isn't it? So, I think if that's the biggest mistake you make, what's happened, I mean, it's an expensive lesson. You know, if you're going to pay for your education, that's one way to do it, but learn from that, you know, and it sounds like he has. So,
and what about the deductibility of that interest?
Yeah, so the tax office are pretty clear about that. So where there's a property where the interest was deductible and there's still debt left, that deduction will continue. So there's some
benefit there.
Yeah, there's some benefit to go. Yeah.
But no income coming from that property any longer, Philip. So hopefully you have learned a little bit of a lesson from that. I mean, it sounds lovely and romantic to have a Port Douglas property. I'd love one, but I just know that it's such a volatile market. Timing is everything in markets like that, and that entire region has been going backwards for a long time. I own a property in Cairns, not a luxury Port Douglas property, but just a two-bedder that I've had for 22 years now, and I think it's still worth pretty similar to what it was when I bought it. It goes up and down a little bit, mostly down, but I learned from that as well. I got that from a dodgy spruiker in a brown suit, and it was the beginning of my own personal property investing education. And as a result of that, I really learned everything that I know today. So for you, I guess be heartened by the fact that when something like that happens, it does make you extra vigilant. And in my case, it led me to go on and buy properties that were really good properties, and therefore now that initial mistake isn't so big for me.
Yeah, that risk for Philip is to be turned off by the bad experience. I think that's what stops a lot of people. Either they fear and paralysis and analysis, and they don't do anything. They do something and it blows up, or they get a bit way along and some things go wrong. You've got to learn from it, you've got to persevere. I mean, ultimately that's what investors do, and the ones who do well follow that.
Absolutely. Yeah. Well, that's about all we have time for this week, and it's been a great night. I think we've gotten through a lot, and we've certainly discussed a lot of different topics tonight, but it does wrap up this episode of Property Investing Matters. If you'd like to become more educated about investing, perhaps grab a copy of one of my books from the online store at destiny.com.au or from most good bookshops. Now, if we answered your question tonight, please send an email to pam@mypropertytv.com.au with the subject book prize. Tell me your name, address and which question you asked, and that lovely pack of books, there it is, will be on their way to you just in time for you to read over the Christmas break. Thanks to Ian for being here tonight and answering all your questions, Ian.
Yeah, my pleasure.
Always great to have you here. You will get you back early in the year, and hopefully we'll give everyone an update on that land tax situation and how
it'll become pretty apparent early next year, I think. Yeah,
okay, yeah. I'm looking forward to that. Yeah. So you look out for Ian next year, and if you want to find him, bishopcollins.com.au is where you can find Ian. He's very generous with his time. Don't be afraid to send him an email, and I know he will be able to help you out. If you have a question or want to contact me between shows, there are all of the things that you can do: email, Facebook, Instagram, Twitter, and my website, all there. And don't forget to go and have a look at our new service, My Property Match. I know it's just right for you, so have a look at that. It is all on the website. And if you're not sure what to do over the break, then just give me a call. We're going to be working here with our clients and delivering that new Property Match service. And that service is allowing investors to get the property which suits them best without any of the hard work. Now give us a call, or as I said, go to the website to find out more. I'll see you back here next week with our final show for the year, where our special guest is yet to be decided. So if you have a request for that final show, send me an email and I'll do my best to get them on, and then we can answer all of those questions that you might have for that last show. I'll see you back here then.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.